Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager and education coach here at Schwab, and this is managing an options portfolio. And there's a question that's come to my mind recently that I think can really cause panic if someone's never dealt with it before, and that is, what do we do when we get assigned early on a short contract, but we own a long? If we're in a spread, do we just automatically assign that or exercise that long to offset the short? That's a good discussion to have. We're going to be looking at an example of that in our paperMoney account today, and just talking through the pros and the cons of exercise versus not exercising to cover a short assignment. All right, so should be very good. Before we get into any of that, though, let me first of all say hello to everybody out there in chat, out there in YouTube land. Great to see Will and Kevin, David, Josh, Bill, the Sim Architect, Ricebird, Kathy, TMTM, everybody else. Thanks for joining us week after week. We always really do sincerely appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in a live discussion. This webcast series kicks off on Wednesdays at noon Eastern. We'd love to have you here in our live audience. And I also want to let you know that Brent Morris, my very good friend, Brent Morris, has been working with Brent for about 20 years now. He's hanging out in the chats with the live stream audience today. He's going to be addressing any questions that I can't get to just during the natural flow of the presentation. So thanks for being there and having my back there, Brent. And Brent and I would like to issue an invitation to you all. If you're not following us on X, please do that. It doesn't cost anything, and it's the best place to connect with your favorite presenters in between the live streams. You can find Brent there on X at Brent Moore CS. You can find me there at Cameron May CS. All right. But with that said, let's get into it. And the first thing that we always do as we launch these webcasts is to pause to consider the risks associated with investing and with trading. These are important disclosures, so please bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed portfolio is solely your responsibility. All right, so let's get to today's discussion. Each week, we have 3 items on the agenda. We have an example portfolio of options trades that we manage from week to week. So the first thing that we're going to do is discuss the maintenance of existing positions. Then we're going to go look at the market conditions and make a plan for a new trade using examples on the Thinkorswim desktop platform. But I wanted to make sure, as we're covering this first bullet point, discussing the maintenance of current options positions, that we have this important discussion about early assignment and how it might be handled, because it can be a moment of high anxiety. I would suspect there are some in our live audience today who have been assigned early on a contract when they just weren't expecting it, because assignment can happen at any time and we're not in control of that. But what we do with that assignment, we have some choices, especially if we have a covering position. So I want to talk about the pros and the cons of, do we exercise that covering position, or is there something else that might actually be a mathematically better choice? So let's go right to our Thinkorswim. And here are our 4 current positions. We have Apple, we have Salesforce, we have Alphabet, and we have United Health. So I'm just going to start with Apple. So Apple, with this, we have a Jade Lizard. If you're not familiar with that, we sold a short put, preferring for price to stay above that strike. We sold a short call spread, preferring for price to stay below those strikes or below that spread. So really where we'd like to be with this combined trade is between our two short strikes, between 220 and 235. And really, if we had to make a choice, maybe we prefer to be closer to 235 than to 220. And right now you can see the stock is at 231.42. So if it helps to visualize things, I go to my charts and I draw, sort of where the trade would like to be as we approach expiration, where we'd prefer not to be. So we don't want to be down here below our short put. We don't really want to be above our short call vertical. Our preferred range is to be right here between 220 and 235. You can see that's right where we are right now. As a matter of fact, the little arrow I drew in here is actually obscuring the current day's candle. We're right there. So that trade is actually doing just fine. We're going to let it continue to work. We still have 16 days till expiration. Next up, though, and this is one that I wanted to have our discussion using. This is a, let me close up this last column here so you can see the full details of this trade. But you'll notice we own a $270 long call. We actually own a pair of those for March of 2025. So those contracts have 142 days on those. So we have a preference when we own a long call for price to rise. Now, against those, we've sold some short calls at the 290 strike. And when we sell short calls, and when we sell short options, generally the trader is looking for those to expire worthless. So these would expire if the stock is below 290 as of the 15th of November. These are 15th of November 2024 contracts. So we've created what's known as a diagonal spread here, a long call diagonal spread with a preference for price to rise, staying above 270, but below 290 would really be optimal. Well, look at where we are right now. We're closer actually to 299. This short call option is now about $9 in the money. Now, even out of the money options can be assigned, but in the money options have a higher risk of early assignment. So I wanted to talk through what might transpire if that were to happen. Okay, so let's just assume that we get assigned. So we're assigned at 290. So what does that mean? Well, when we've sold a short call, that means that someone has the right to buy shares from us for $290 if they choose to. And if they were to assign that contract, we would be left short stock, however many shares. That would be 200 shares in this case. I'm just going to set the shares aside. Doesn't matter. We're going to talk in just per share values for this discussion. All right, so let's just assume that we're assigned somewhere between now and expiration, but let's just say it happens right now, and it leaves us short those shares of stock, and all of a sudden, our heart rate goes up, mind is racing, we're wondering what do we do? We're now short shares that we never intended to be short. We just wanted to do this diagonal spread and cruise safely to expiration. That's what we were hoping for, and that's not what's really happened. Sim Architect, yeah, oh yeah, let me clarify that. There's just a question in the audience, in the live audience right now. It's called the Jade Lizard, the trade that we placed earlier. Well, I don't know. Let's look at maybe exercising. Let me make this all caps, just sort of stands out. This is sort of choice number one. Let's say that the trader, they've been assigned the short contract, leaving them short those shares at $290, and they think, oh, ooh, all right, my heart rate's going back down again because I have the right myself to buy shares for $270. So even though I was required to sell shares at $290, I can buy the same number of shares at $270, and oh wow, that actually would be a $20 profit on the stock. If I don't do this, so let's say that we do assign, or we do exercise. So we exercise, or in other words, we use our contract to buy to cover that short position. All right. Now that results in a $20 profit on the stock. Right? If we buy shares at $270 and we sell at $290, that's a $20 profit on just the stock. And if we compare that to not exercising, what would we be left with? Well, in that case, we had to sell shares for $290. They're worth right now, I'm going to round this off to $299 just for simplicity's sake. Let's say the stock is at $299. So we had to sell it for $290. If we were to just say buy to cover the shares at $299 without dealing with our long option, we'd be looking at a $9 loss on the stock. In other words, or another way to say that is that we have an unrealized loss on the shares right now. So it would seem that exercising and buying to cover reverses this $9 unrealized loss on the stock into a $20 realized gain on the stock. Wow, that's a plus $29 move. Why in the world wouldn't we do this? As a matter of fact, mathematically, this is not the best thing to do. Why not? What's the missing part? Before checkout 2 says selling at 290, 200 shares that you do not own. That's exactly right. So we're left short. And how do we close out that position? Well, we have to go buy some shares. And we could just go buy those shares on the open market at, approximately $2.99. I realize it's moving away from that a little bit right now. But for the sake of this discussion, close enough is good enough, right? So we could do that, or we could just enforce the terms of our long contract and buy the shares at $2.70, which we're contractually, we have the right to do. So what are we missing out on here? Harry is exactly right. If we do this, what we're actually doing is surrendering the current value of our long option. How much is that long option worth right now? Look at this. 44. I'm going to do a little bit of rounding again. I'm going to say that thing's worth $44.25. Okay. So we surrender the premium. When we exercise a contract, that's the value we get out of it. We don't get it. We don't get to exercise it, get to buy the shares, and also get to retain the value of the option. That's surrendered. So that actually subtracts $44.25 from this equation. So what is our net? And I'm going to call this a net return of value. That's just my phrase. That's how I think of it. Well, according to my math, a $44 surrendering of value to achieve a $29 increase in value results in a net loss of $15.25 of value. Now, this is versus not exercising. And I'll explain that in just a moment, just sort of reversing all of this. So is this making sense? It can be on the surface attractive when we're stuck and we're in that panic mode. Just got assigned shares of $290, and you're like, what do I do with these? It's hot potato. Got to get rid of these short shares that I didn't want. Well, I could buy them back, but that's going to cost me $299. That would be a $9 loss. Or, genius idea, I could exercise my long option. Hey, buy those shares at $270, covering the short shares at $290. That's a $20 profit instead of a $9 loss. It's $29. Genius move, except mathematically, it's not the right thing to do. In almost all scenarios, option B is going to be the mathematically correct thing to do. Option B, let's not exercise. But if we want to be done with those shares, if we just want to exit the whole thing, what might that trader do under that scenario? Well, they might choose to just sell the long call. If it's worth $44.25, let's sell it. Sell the long call. That retrieves value. Let's assume that it fills at $44.25. Obviously, we don't know what an option is going to sell for. If there's sufficient liquidity and we're able to get out, how much are we going to get? We don't know until it fills, right? But we sell that long call for $44.25, which means we no longer have the right to buy shares at $270. If we want to close out the short option, for which we were only paid $290, we might have to buy the stock, buy that back. So we buy to cover the stock position at $299. Stock is $299. That's what we might have to buy it for. What does that result in? Well, that's a $9 loss on the stock versus what we could have had a $20 profit on the stock. So this is a $29, I'll put the zeros in there just to be complete. But yeah, that's a move in the wrong direction, right? So on the stock, we're settling. It's not good. It's not as good as maybe doing choice A. But we were able to retrieve the full value of the long call. So what is the net return of value? In this case, compared to exercising, that's a plus $15.25. In other words, collected $44.25 at the cost of, $29 less attractive exit on the stock. There we go. So I'm just doing this on one example, but if we were to run this scenario on any number of diagonal spreads, on any number of vertical spreads, on any number of calendar spreads, credit spreads, debit spreads, yeah, but in this case, yeah, if the short option gets assigned, it's not usually going to work out, very rarely going to work out that the trader should exercise in order to offset the share position. Okay, let's see. I'm trying to read through the chats. I think, I missed the context of one of those. So I can't address that. Thank you, Brent. I know you're doing a great job of assisting with those. Now, there is a time when it's sort of a wash, because there's a specific reason that one of these has a $15 advantage over the other. What is it that's contributing all of this extra value to the long call versus just exercising? That's actually the remaining time value in the contract. When a contract is exercised, that time value is surrendered for no compensating value. That's just lost. That's what's really being surrendered here. So is there a time, or are there circumstances under which there are really not any time value to be surrendered? Yeah, a couple of scenarios. Either we've gotten all the way to expiration and there's no remaining time value, or it's also possible if a contract has gone way in the money, and that could also be a contributing factor to why the short was assigned in the first place. But if the long option doesn't really have any time value, then there's not really anything surrendered here. So in that case, it sort of becomes a wash. It's not that one is better than the other at that point. It's just kind of a wash, right? So there we go. I did want to go through this. You know what? I don't like this not exercise. I'm going to rephrase that to don't exercise. That just looks better to me. All right, so we've had that discussion. This is all hypothetical at this point. One thing about paper money is this scenario never crops up. That's not like real life. In paper money, no short options are ever assigned early, but in real life, that can certainly happen. So hopefully, when we're trading in paper, it gives us the opportunity to learn these sorts of lessons, to think through these sorts of scenarios where we don't really have any skin in the game, and there's not really any risk anyway. So with CRM, what should we do with this position? How's it going? It is in the money. Does that mean that it's unprofitable? No, as a matter of fact, it is doing quite well, up $1,220 right now. With this, we'd prefer to be below 290, but the trade is actually still profitable if the stock goes up. So here's where we are. We're in profit territory. It's just that we'd really prefer, if we're trying to avoid assignment, to be down below this 290. That puts it out of the money, but just remember, even out of the money contracts could be assigned. Once we get beyond that November 15th expiration, if our short option has expired, now we just want the stock to go racing up. But I would say trade's doing just fine at the moment. Google is a very similar scenario, another long call diagonal spread. But in this case, we own the 165 call. We've sold the 170 call. The stock is rallying. But we're still profitable on both of those. And you'll notice, let me ask you this question. With both of these, if our preference is to be below that short strike, and in both scenarios we're above that short strike, well, does that mean that we're going to start losing money if the stock continues to rise? Nope. There's actually data right here on your screen that can tell us how these trades are likely to perform if the stock goes up another dollar. There's your hint. Look at our Salesforce diagonal. If the stock were to go up another dollar, the net return, unrealized gain between the long and the short would still be positive. If Alphabet continues to rally, it would also still be positive, just less positive. All right, so with both of those, I'm just going to let them work. With United Health, with this one, we have a bull put spread. We sold the 550 put, bought the 540 put, both in the same 15th of November expiration. With this, we prefer for the stock to be above 550. Right now, it's at 565, so it's working in the right direction, but this is a pretty new trade. We just placed this last week. So this was last week's trade. As a matter of fact, maybe it's not moving in the right direction. It might have just been that it was far enough. Let's see. Oh yeah, we placed the trade right here. It's actually kind of gone sideways to slightly down. So we moved a little bit toward our strikes. We'd prefer to be up here though. Josh says, sorry, missing something here. If we got assigned the short stock, wouldn't we have received premium for doing so? Our cost is less than $290, price is $299. We just sell the shares and profit. Okay, Josh, yeah, we did get a short option. If it's assigned, you now have a realized gain. And I wasn't calculating profit. Notice I very carefully set aside profit from the net scenario. We did talk about profit on just the stock portion. But for true profit, we'd have to go back and build in, well, how much did we receive on the short option? How much did we pay for the long option? I didn't want to go that far. Instead, I just wanted to talk about, well, here's the current scenario. How's the best way to exit this thing mathematically? Short option, though, you're right, Josh. That one is now a realized gain, right, on the assignment. But that doesn't mean that we can't still botch things up with the way that we handle the exit. All right. So good question. Let me read. Cost is less than $290. Price is at $299. And remember, we had the cost that went into the long option as well. So we had a net debit on this trade to start things out. That would have to be factored in as well. Okay. Let's get on to adding a new position to this portfolio. Right now, our portfolio is slightly bullish. You can see we're beta weighting against the S&P 500. What that does for our delta column, it gives us this bottom line number that estimates for us how our portfolio is likely to perform if the S&P 500 were to go up or down just a single point. So if the S&P were to go up a point, it would project a small profit of $2.71. It's an estimate, but generally a pretty good one. If the S&P were to drop a point, lose $2.72 in unrealized loss. Now, if we get larger moves, and in most days we do get larger moves than that, then we could be seeing larger gains or larger losses. But the bottom line here being, we're somewhat bullish in our portfolio right now across all of our positions. The net there is that we're bullish. But some of you might look at that and say, Cameron, yeah, it's bullish, but it's kind of bullish. It's slightly bullish. If a trader really thinks the markets are going to go rocketing up, maybe they want to dial this up. Let's go have a look at what's going on with the S&P right now as we plan for a new trade. So here's the S&P. It's been an absolutely fabulous 12 months for bulls. And even as we're talking right now, we're trading within about 1 percentage point of those all-time highs. And let's just say that our hypothetical trader here who's managing their portfolio, they're looking to put on a new trade out here for December. We already have a bunch is a relative term. We have a few for November 15th. So let's go out here and plan a trade for December. Start to layer in a little bit of time diversification. Well, let's suppose our trader thinks, all right, I think, isn't the last part of the year typically bullish? Yes. Do we also have something else to consider between now and December? There is an election coming right around the corner, November 5th. So that's a concern. And for some, maybe they sidestep it. Maybe they say, I'm not going to add anything. I'm not going to do that. Let's add something to the portfolio today. Let's say that our trader thinks, well, unless something dramatic happens, maybe this already previously established bullish momentum is likely to continue, and therefore maybe we want to dial up this bullishness on our portfolio. And at the same time, they're trying to decide whether to do that with long options or with short options. What do you think? Is it more of a buyer's market or more of a seller's market for options right now? Well, as we're approaching that presidential election, options premiums, and it could be for that, could be for other reasons, but premiums are still pretty high compared to where they've been historically. If you look at the volatility index of the S&P 500, which has a close correlation with the general pricing of options, there have only been a few weeks all year. Looking back over the trailing 12 months, how many total days, maybe 25 days, where volatility levels and therefore options premiums in general have been higher? So Naresh says it looks like more of a seller's market. Let's say that our hypothetical investor agrees. They think that maybe options are literally selling for a premium, and so maybe they're going to go sell some options to add to the bullishness of their portfolio. So that's what we're going to do today. Let's bring up an example stock, and we're going to build. Oh, yeah, it moved a little bit in the direction I was planning. Anyway, let's look at Visa. Let's say that our trader, who's bullish on the markets, looking to sell some options to take advantage of that bullishness, hopefully. Maybe they also emphasize what's going on with stock charts, and they might look at this and say, in recent months, since July, Visa's really been on a tear. Up and down, but net, making higher highs and higher lows. Plus, we've recently pushed through this 12-month resistance on an earnings announcement. Yeah, so for those that are trying to sidestep earnings, and I'm not saying that everybody should, some traders actually target earnings as a strategy. But let's say that our trader here just likes the fact that we've gotten past earnings and it's given a boost to the stock up through resistance. Maybe it's time to place a bullish credit trade at selling options on this. Now, there could be other pre-qualifiers for using a stock like Visa that have nothing to do with the chart. For some traders, they also emphasize the price per share. Lower price stocks just tend to have fewer options to choose from. And maybe liquidity is a concern for some traders. Illiquid stocks tend to have illiquid options, which can make the pricing difficult. It creates wide spreads between the bid and the ask price, makes it even harder to trade those option strategies profitably. We already know it's already difficult enough when directing one's own portfolio to do it profitably. We don't need to instate unnecessary barriers. So for some traders, liquidity can be one of those things where we're just removing a potential barrier, or at least minimizing it as much as possible. So let's put together a bullish trade here for Visa. And I'm going to do that. Let's come down below. And we're going to do an example trade. And we're just going to do just like last week. Last week we had kind of elevated volatility levels. This week we still have elevated volatility levels. We're going to do a net credit position. We're going to do a bullish put spread. There we go. We already have one in the portfolio. Let's add a second. And I said we're going to go out to the 20th of December for this one because we already have options expiring on the 15th of November. And with a bull put spread, the way a lot of people think about this is the real driver of the trade is the short put. So we're going to start things conceptually by selling at 20th of December. And how about we look at, let's see, where was our broken ceiling here was right around 290. So, and our trend line is really stretched up above 285. No, it's actually still below that. Anyway, let's look to see if we were to sell maybe a 280 put and possibly buy a 285 put to create our vertical spread, carry those out to the 20th of December. What could we get for that? So the 280 put is trading between 305 and 320. Let's say that we're able to sell that 280, actually I said 285. Let's say that we're able to sell that 285 put for between 430 and 445. Let's just say we're able to get 435. I think I said that ask was 435. It's actually 445. Actually, it looks like we might be able to pull out 440 at the moment. Prices are flashing and changing. The markets are open, so these things are going to change. So what does this do for us? We're getting into a contract where we're accepting a payment from, really, at least conceptually, this is the way that I think about it, accepting a payment of $440 from another trader out there somewhere in the options universe. And in exchange, they have the right to sell shares to us for $285 through the 20th of December. They're less likely to do that as long as the shares are worth more than $285. They can sell shares at a higher price to somebody else. If it slips below $285, though, that's where we start to get elevated risk of assignment, where we might have to buy those shares at $285. So to help us with that risk, at the same time, we're going to buy a December 280 put. It's going to be a little bit less expensive. Looks like it's around $315. So here we're taking some of that $440. We're spending $315 of it, and that's giving us now the contractual right to sell shares for $280. So if we get stuck with them at $285, we hope we don't, but if we do, now we know that worst case scenario, we have the contractual right to sell those same shares for $280, and that minimizes the risk exposure to $5. And it's further minimized by the fact that we're collecting a credit to set this deal up. Our net credit, or theoretical maximum gain here, is, well, we collected $440, spent $315, that's $1.25. That's our net credit. So if we have $5 of risk, if we ultimately get assigned those shares at $285 and we ultimately decide, or we ultimately do exercise at $280, remember, it's not always the best scenario. At expiration, though, it's done automatically, because at expiration, there's really not an available better way to exit. Okay? So in the money contracts are all automatically assigned at expiration unless there's a do not exercise order in place provided by the trader themselves. Anyway, but have to buy the shares at $285. We can sell for $280. That's a $5 loss, for which we were paid $1.25 to set that up. So it really leaves us with $375 of risk. So that's the way that works. So those are sort of the mathematical facts of this trade. It's a lower reward, higher risk trade, because with vertical spreads, when there's a high probability of success, there's a smaller reward for being successful. And in this case, we just need the stock to be above 285 at expiration, and it's already solidly above 285 right now. And as a matter of fact, if all we're looking for is for the contracts to expire worthless, and specifically for the stock to be above 285 at expiration, leading to both expiring worthless, well, there's only a 31% chance of the 285 contract expiring in the money, or in other words, a 69% chance of the contracts expiring out of the money. So yeah, 69% probability here. I'll throw in prob for probability. And there's only what probability that the stock falls below and remains below 280 at expiration? 24%. With some chance that we wind up in between the two. Priya says, is this trade based on a bullish hammer candle today? Well, Priya, it's tough for me to know when I'm planning these webcasts what the candle's going to look like, because it's going to change from moment to moment. I didn't really see a hammer here. So a hammer typically looks like a small-bodied candle with a long tail on it, like that. Not much of a wick sticking out the top. This is a small-bodied candle, but if you look at the size of the wick sticking out the top, try to envision grabbing the handle of a hammer built like, let me zoom in a little bit. Just imagine, here's our hammer head, and here is the handle. So we're grabbing that handle, we go to swing, and you got all this wood sticking out the top. It's not going to be a very effective hammer. It's going to hit the ground before we're able to make contact with the nail or the spike or whatever we're trying to drive. Yeah. So it's not for that reason that we don't like to see the wick sticking out the top. There's a psychological reason for this, but it's just the way that I think about hammers. They shouldn't have much of a wick sticking out here. The real psychological reason, the sort of logical underpinning of the hammer pattern is that we should be pretty close to the top of the day's trading. That's more of an indication of bullishness to a technician in most scenarios than being, in the middle of today's trading. Okay, there we go. A little bit of a hammer lesson. Good observation there. I always like it when somebody presents me with the opportunity to give a little bit more education. Terry says it looks more like a spinning top. I agree with that, Terry. Yeah, a little bit of a spinning top as we've broken through this resistance. I think you can guess why it's called a spinning top, because if you've ever spun a top, as with like a child's toy, its center of balance, that center of mass, should be balanced between points above and below, right? Yep, that looks like a spinning top to me, which really just translates to indecision, which I think for some might be not surprising. Given the big move this has already made, do you think there might be some sellers saying, wow, time to take some profits? Could be. Do you think there could be some buyers saying, wow, this thing's on the move? It could be. Could there be a little bit of a tug of war going on between those two? Priya, you're welcome. Yeah, definitely. All right, let's go place this trade, though. Let's go to our trade tab. And I'm going to go for that 280, 285 strike pair. And what we want that to do, we want this to boost up our overall portfolio delta. The trader here, who maybe was unsatisfied with making $2.70 on a $1 on a 1 point move up in the S&P, maybe they're trying to dial that up. So let's see if this is going to do this for us. Quick way to gauge that, if we go to spread single and we set that to vertical, now we can look at our delta column, look at the combination here, and it says minus 8 cents. Oh, that would have a negative impact on our delta. Yeah, if we were going to buy the vertical spread, but we're not. We're going to sell it. When we sell a vertical, it inverts these numbers, so this would make a positive impact to our portfolio delta. So let's click on the bid price to create that sell order. And it looks like the net credit right now, let's see, what did we calculate originally? So we were looking at maybe $1.25. Let's see. Looks like we might be able to get, I'm gonna shoot for that. Since those are the numbers we ran, I'm going to move my slide bar closer to the natural, a little bit away from the mid, maybe dialing up the likelihood of a fill here on the order. But we're just going to try to get at least $1.25 credit here. That would leave us with a risk of $375 per contract. So the trader would just have to ask themselves, well, if the whole trade goes south and I lose everything, how much am I okay with losing? Nobody's okay. It's easy to say, oh, I don't want to lose any money. There is no way to not lose any money. We can stuff money under our mattress and lose money to just inflation. We could go, buy a short-term government-issued security. Well, that's low risk, but that's not no risk, right? Anyway, I think you get the point. We're going to take some risk, and we just have to be aware that risk is real. And if we incur that loss, how much can we absorb? Let's say that our trader here is okay with this portfolio. It's over $100,000 portfolio. Let's say that we're willing to risk about $4,000, 3 or 4% of the portfolio size. Well, 10 contracts would be $3,750. We could do one more and move just a little bit above $4,000. Let's do 10. There we go. and I'm going to confirm and send this order. We're going to sell 10 of these verticals, looking to get at least a $1.25 credit. That would be $1,250 that we could make, $3,750 that we could lose on these 10 contracts, plus commissions that whittles away at our credit. So our net credit might be $1,237 if we fill it $1,250 or $1.25. So let's send this order off. And all right, we actually got $1.30 for this. A little bit more reward, a little bit less risk in this trade. But let's go see what impact we've now had on our portfolio delta. If you remember, it was slightly bullish. It was, anticipating a 1-point move on the S&P might produce somewhere in a $2.70 range unrealized gain on our portfolio. Well, now $6. For checkout 2 says, Cameron, am I not going to place an opposite order? Now we could. Sometimes I do, sometimes I don't. Sometimes it's a point of emphasis to show that a trade, an exit order can be placed right up front. At other times I prefer to leave that part of the discussion for just talking through the exit as the trade moves. And so that's kind of what we're going with here. We always make our trade decisions on camera, but I will say, yes, we could put in closing orders either to manage our upside or manage our downside on this trade. But I'm not going to for this one. All right, good question. Just know that if we did use, let's say, a stop, that would not be a guarantee that we would get filled at a specific price. But we've accomplished what we set out to do today. When I kicked things off, I really wanted to give the emphasis, an early discussion to the management of an early assignment. What does a trader do when they think, I'm in this position, we're just going to let it go to expiration or until I decide to exit and then someone else decides on our behalf to do something different and unexpected. Early assignment can cause the blood pressure to go up, but the trader needs to keep a calm head, weigh the pros and the cons of different things that can be done. And we weighed a couple of them, exercising the long option versus not exercising a long option. But there are other things that might have been done, definitely. Everybody, thanks for giving me your time today. Thank you, Brent, for helping out there in the chat. I did not see, let me double check here. Did not see a survey. No survey today, but I do have a quick couple of requests for everybody that's watching the live stream right now, and actually for those that are watching the archive after the fact. Just remember that you have other resources outside of these webcasts. So you can follow your favorite presenters on X. Doesn't cost anything to follow them, but you can find Brent on X at Brent Moore CS. You can find me here at Cameron May CS. But that's the best place to connect with us in between the live streams. You can also, and I would strongly suggest you do this as well, subscribe to our YouTube channel. Doesn't cost anything. It only takes a second. That's always appreciated. Always make it a habit if you would. Click that like button. Anytime you enjoy one of our webcasts, and it's like applause to your presenter, and it also gives their webcast a boost in the YouTube algorithm. Everybody, thanks for giving me your time today. I will look for you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.